called Know Your Market Navigator. This is the second series in this month. We had our first series 15 days back, where we had our fund manager Kunal Sangoy covering Digital India and pure value funds. Today we have with us Mr. Vishal Gajwani. Uh, in terms of work experience, he has over 17 years of work experience in equity research and portfolio management. Vishal has extensive experience of managing equity portfolio across investment cycles. He, along with his team, is accredited with conducting differentiated market studies, capturing interesting insights on various aspects of investing, translating into superlative performance track record. In terms of funds, he manages two of our key funds, and in current market scenario, these two funds holds the fort. One is the balance advantage fund, and second is the small cap category. So for the investors who are entering the mutual fund business, or for the retirees who want to park their funds, balance advantage is best suited. And for people like in our age bracket who wants to make returns, and market is also supporting. So today also Nifty was up by more than 50 points. So small cap is the opportunity. So none better than Vishal will help us to navigate both the funds, how we are positioned, what we are doing in this fund, and how one can look at these both the funds in current times. In terms of academics, Vishal is a gold medalist, chartered accountant, all India ranked #1, and holds a master's degree in commerce from MS University, Baroda. Vishal is also a CFA chartered holder from the CFA Institute, USA. So I will not take much of your time. I will hand over the proceedings to Vishal. So Vishal, over to you.
Yeah, thank you, Mehul, for the lovely introduction. So what we will do is that we will run through presentations, very brief ones for Balance Advantage Fund as well as Small Cap Fund, and post which we will take questions from the audience. So to begin with, let me just share the presentation of Balance Advantage Fund with all of you. Yeah, hope the slide is visible, Mehul.
Yes, Vishal, it is.
Perfect. So, Mehul gave a background about myself. Just to again summarize, I have been with Aditya Birla AMC for the last 10 years. And of those 10 years, for 9 years, I was with heading PMS Investments, PMS and AIF Investments. And over there, we had very strong practice of small and mid cap portfolios. So we had very good track record of performance over there for small and mid cap portfolios. And also we had asset allocation strategies over there, which looked at allocating assets between equity and debt. So these were the strength areas that we had on the PMS AIF side. And that's where when I moved to the mutual fund side, which was in April of 2022, which is 18 months prior, I took over these two funds, which is Small Cap Fund and Balance Advantage Fund, because of the prior experience, both in case of small and mid caps, as well as asset allocation strategies. So what we did is that in Balance Advantage Fund, after I took over, we made certain improvements in terms of the asset allocation, the model that we introduced over here. So that's something that we will touch upon while we cover the Balance Advantage Fund. So having given this background, let me just share with you what has worked in the markets and why asset allocation is so important. What we have seen in the past is that whenever the markets are cheap, the forward returns are decent. So for example, here we have given in this table, we have given an example of Nifty 50 index. What you can see here is that when the Nifty 50 index PE multiple, starting PE multiple is 14 PE and below, then the next 3 years, future returns are 37% annualized. And as the PE multiple of the index goes up, the next 3-year returns, future returns come down. And at a 25 PE multiple and above for Nifty, the next 3-year returns are 8% annualized. So it is always better to allocate more to equities at lower PE multiples and vice versa. And that's what we try to achieve through dynamic asset allocation in this balanced advantage fund. Here, what you can see is that on the left-hand side table, you can see the adjusted PE ranges of S&P BSE 100 index and what is our net equity exposure. If the index PE multiple is below 14 times, our net equity exposure would be 80% to 100%. And as the PE multiple of the index increases, our net equity exposure keeps on coming down. At a 25%, 25 times PE multiple, our net equity exposure range would be 0% to 40%. And on the right hand side chart, you can see how it has played out for us in the last 8 to 10 years in terms of how this framework has helped us in the past. So what you can see here is that the yellow line is the PE multiple of the index. That is the adjusted PE multiple. When we say adjusted, it is adjusted for loss-making companies. We only look at profitable companies while calculating PE multiple. And this PE multiple is considered on a consolidated basis and not standalone. So these are the two adjustments that we make, that we remove loss-making companies and we only look at console numbers. This helps us because generally we look at price to earnings only when the earnings are positive. If the company is in a loss, we look at price to book and not price to earnings. And therefore, we exclude the loss-making companies from the calculation of PE multiple. Because sometimes it gets, the number gets vitiated because of that. For example, if let's say Tata Steel comes up with a very big loss, 50,000 crores loss because of coal's operations in UK, then the PE multiple of the index will become expensive because Tata Steel is loss-making company in the index. But the index PE, therefore, we need to normalize this by excluding loss-making companies while calculating adjusted PE. So now, having given you the background and how it is calculated, if you look at the historical performance of the index, you will see that as the PE multiple, the yellow line, it has gone up, our net equity exposure has come down. And similarly, in January of 2018, which was the peak of the market, when the market PE multiple was very expensive, our net equity exposure had fallen to below 40%. And as the market PE multiple later on came down, we gradually increase our net equity exposure. And that's something that we increased as the market PE multiples came off. And here during COVID times, market PE multiples collapsed. And that's the time when we increased our net equity exposure all the way up to 80%. So that's where we were able to capture lower price points in equity markets and increase our equity exposure in response to the fall in index levels. And as the markets gradually recovered post the COVID lows, so in June of 2020, we were almost 80% invested in equities, and that was a very good time to buy equities because the market levels were low. Index was down 35 to 40% from the peak. And post that, as the markets went up, we kept on booking profits and reduced our net equity exposure as the markets went up. So that's how one can see how in the past, for the last 7-8 years, this model has actually helped us to navigate the markets well and be over-invested when the markets were cheap and under-invested when the markets were expensive. Right now, as we speak, our adjusted PE multiple of the index is 22.5 times. And therefore, this falls in this range, 21.5 and 25. And our net equity exposure should be in the range of 30% to 60%. And right now we are at 52%, to be precise. And how do we decide between 30% to 60% where we should exactly be? Because this is a wide range, 30% all the way to 60%. Therefore, we use what we call asset allocation model as given here, which actually calculates the net equity exposure based on 8 different parameters. And based on the combined score, we decide the net equity exposure, which at the moment, as per the model, it is 52%. So based on this asset allocation model, the combined score of 8 different parameters, we decide exactly where we should be between this range of 30% to 60%. This asset allocation model has got 3 categories of ratios. First category is valuation ratios, which looks at price to earning multiple, price to book, and yield gap. Yield gap is the difference between earnings yields and government securities yield. So these are the 3 ratios on the valuation side. Then the next 3 ratios are trend ratios, which look at linear momentum, momentum reversal, and copper to gold ratio. Copper to gold ratio is a momentum indicator. If copper is doing well, it's a bullish indicator. If gold is doing well, it's a bearish indicator. Last one is volatility ratios, which look at India price volatility and also the US price volatility. If the volatility is high, and that is bad for equity markets, lower volatility is good for equity markets. So this is the combined ratio that we look at for deciding exact asset allocation for the balance advantage fund. Historically, now if I look at the performance of the fund, it's been pretty consistent. On a 1-year basis, this is a slightly dated data as on 31st August 2023, but the latest data is also pretty close by. As we speak, on a 1-year basis, fund rank is 5th rank out of 17, and the rank has been consistently in Q1, Q2 over the last 5 to 7 years. On a 5-year basis, the rank is 5th rank out of 12. So that's on the performance of this fund, which has been consistent Q1, Q2 across time frames. This is an interesting example on rolling returns that have been generated by this fund over the last 3-year rolling returns and 5-year rolling returns over the last 10 years. So if I look at the 3-year rolling returns, the fund has generated 11.98% returns on a 3-year rolling basis for the last 10 years. And the same number for 5 years is 11.1%. What is interesting is that almost 86% of time, the fund has generated 8% and above returns on a 3-year basis, while 96% of times it has generated 8% plus returns for 5-year rolling investors. So if an investor is coming in this fund and remains invested for 5 years, so what one has seen in the last 10 years, his returns would be 8% and above for 96% of times. And for 36% of time out of this, the returns were 12% and above. Now, in terms of upside participation, we have seen that with a 50% net equity exposure on an average, 51% net equity exposure, the returns have been 92% of Nifty 50 returns with a much lower volatility. So lower volatility and much better return experience on the upside. On the downside, the experience has again been better. When market has fallen on an average 17%, the fund has fallen around 9%. So downside capture is around 50%, upside capture is 94%. So that's on how the fund has behaved in the past. Coming to portfolio positioning, on the equity side, it's a pretty conservative positioning. Large caps is 38%, mid cap is 8%, small cap is 3.8%. Balance is fixed income and arbitrage. On the debt side, again, we are not taking too much risk here. It's an accrual strategy with the yield of YTM of 7.8% and duration of 1.9 years. 100% of the book is AA and above. So not too much risk on credit side or duration side. In terms of sector positioning, we are positive on and overweight on sectors like healthcare, FMCG, telecom, real estate, and underweight on oil and gas, IT, construction, and metals. That's on balance advantage. Now we will move to the small cap fund, post which we'll open the floor for Q&A. So on the small cap fund side, as I mentioned, we have had very strong track record of performance on the PMS and AIF side. So we thought that let us bring those best practices over here in terms of the investment framework. So that's what we have done. The investment philosophy and framework is something that we have been practicing for the last 10 years. And that's what we have implemented over here as well for the small cap fund. What you can see here is that the fund, if you look at the investment philosophy, it is basically looking at industry, business, and management, which is IBM. Idea is to invest in industries which are having large size of market opportunity. Within that, invest in businesses which have very high growth potential and the quality of business is great, followed by management, where apart from business track record, the company should have very high standards of corporate governance. So these are the three starting points, which is high growth industry, good quality business, and credible and ethical management. So these are the three tick boxes of industry, business, and management. For small caps in particular, two additional parameters are very important to generate consistent wealth in this category. And that is that we should be early to identify stocks for small cap investing. We should be one of the first ones, ideally, among the first ones to identify the stock and buy the stock in the fund. And we should have a long-term focus, which means that we are not buying the stock for 20, 30, 40% upside, but to make sure that we stick to the business and grow with the business. So ideally, our cutoff is 100% returns on a 3 to 4 years basis. So we are buying not for short-term trade, but for long-term investing. And lastly, in small caps, because of liquidity issues, one has to have very strong risk management framework. And that's where we have a risk management framework in the form of liquidity management. Maximum investment in the company has to be between 3% to 6%. Second is we need to constantly review the portfolio performance and diversify across stocks and sectors. So these are the ways we can minimize and mitigate the risk in small cap investing. So that's on the investment philosophy part. The themes that we are positive on include Make in India, infra and affordable housing, consumption, and technology digital. Based on these themes, you will see that the industries that we are positive on include financial services, capital goods, IT services, consumer durables, automobiles, and FMCG. These are the sectors that we are positive on, we are overweight on, and these are exactly where we are positive on in terms of themes. Top 5 stocks of the fund include stocks like JK Cement, Cholamandalam, Go Fashion, Hitachi Energy, and Star Health are the top 5 stocks in the fund. These are some of the changes that we have done in the last 1.5 years. Almost 40 stocks that we have bought. Some of the success stories for us out of these new buys that we have done include stocks like Ujjivan Small Finance Bank, Gokaldas Exports, Anurathi Wealth, Cyan DLM, PB Fintech. Each one of these stocks are up almost 100% plus from our purchase price. So that's on the success stories. Top 5 stocks have delivered more than 100% returns. Post which some of the stocks like Rainbow, eMudla, MTAR, Triveni Turbine have given between 70 to 90% returns for us from our purchase price. Some of the laggards in the fund which have not done well after purchase include stocks like Elin Electronics, Butterfly, Mahindra Logistics, City Union Bank, etc. However, the weightages over there are much lower. On an average, if I look at it for the last 1.5 years, the average returns of these stocks has been 32%, while the Nifty Small Cap Index has given 15% returns over the same period. So these stocks that we have purchased new have delivered much better than the benchmark for us over the last 1.5 years. Coming to the performance of the fund, performance has improved. These are the top 5 stocks, performing stocks in the fund. Hitachi Energy, Cyient, Ashok Leyland, Radico Khaitan, and Persistence are some of the top 5 performing stocks. In terms of fund performance, it is now on a up to 1 year basis, the performance is improved to Q1, Q2. So as we speak, 1 month, 3 months, 6 months, up to 1 year, it is Q1, Q2 vis-a-vis peer group. So that is on the small cap fund. So I will stop here, and now we can open the floor for Q&A. Back to you, Mehul.
Yeah, thank you, Vishal, for the wonderful insight and the thought process you have put both in balance advantage as a fund and small cap as a fund. It gives the confidence in terms of how you are managing both the sides of the fund, whether it is small cap, where we have seen in last 1 year, this particular category as a small cap index has gone up by 35%. So I will just club 2 questions which I have. One is, at current levels, how you see the markets from here. So what is your outlook on the markets at current level from here as an investor if I want to invest? And second, how you look at small cap as a category?
Sure. So I think what we have seen, as you rightly mentioned, Mehul, that the markets have been pretty generous. So if I look at, let's say, from a financial year to date basis, which is from 1st April 23 till today, in the last 9 months, last 6 months, what we have seen is that the small cap index is up 46% in the last 6 months, while mid cap index would be up 30% and large cap is up possibly 10-15%. So clearly, small caps have outperformed quite well over the last 6 months. And longer term performance is also looking good for the small cap index. Considering the very sharp run up we have seen, there are areas within the small cap space which have become expensive and where the stocks are running ahead of fundamentals. And therefore, one should be cautious for those segments of the market. And see, small cap, unlike large caps, are always stock specific. So here one cannot have a generic view on the entire category. Clearly, we are seeing euphoria and exuberance in certain pockets in small cap category. However, for a discerning investor, we believe there are still areas of opportunity, we would say, where the risk reward is favorable, where the earnings outlook is very strong, where the valuations are not that expensive. So one has to be very discerning within the small cap space. There are pockets of opportunity, and which is what one has to target. That's what we are doing here. We are actually booking profits in stocks where the stocks have gone up 2, 3, 4 times over the last 1 or 2 years, and redeploying that money into stocks where we believe upside potential from here can be higher. So that's how we look at it. In small caps, one has to be more stock specific, and overall markets may have become expensive, but I think for an investor who is coming with a 3 to 5 years time frame and with an SIP STP route, I think his experience should be good. The other thing, Mehul, is that if an investor is looking at the last 6 months to 9 months performance of small cap, one shouldn't be get swayed by that performance and come with a high expectation of returns at this juncture. So one should have reasonable expectation of returns. Having seen 46% returns in the last 6 months, one shouldn't extrapolate that number going forward, because if one will have high expectation, then the chances of disappointment will be much higher. But if one comes with reasonable expectations and long time frame, then I believe the person will not be disappointed.
So thanks, Vishal, for that. So recently, we have seen JP Morgan adding the government bonds into their benchmark for effective 2024. So guys, we are going to have a pan-India call on coming Thursday, that is 5th October, where we will have Kaustubh, who manages our debt portfolios, taking us through on the debt side how it is going to be positive, negative for entire thing. But just to understand or just to get the tip of the iceberg, how it is going to impact equity as such? Do you think these particular move will help the equity markets?
Right. So that's a good question. So what we are seeing here is that since Indian bonds, government bonds, have got included in the JP Morgan bond index, the immediate effect of that would be lowering of the yields for the government paper and also for some of the other bigger private sector companies. So clearly, there could be a benefit of 10 to 15 basis points in terms of yields for government paper and also high quality private sector paper. And that will actually lead to benefit for, let's say, companies like within the NBFC space and also in the real estate space, because these are sectors which are going to get impacted by interest rates changes. So since the change is positive for the interest rates, NBFCs and real estate sector can actually benefit.
So thanks, Vishal, for it. We have a question in terms of, again, more of a outlook on market. Being an election year, and maybe in next couple of months, it will start from a few of the state elections, which are key. So do you think that will impact the overall rally? How we are seeing the liquidity coming in? Typically, we see in an election year, markets are mostly positive on accounts of liquidity. So we see the same trends, or how it is this year?
Yeah, so right now what we can see, Mehul, is that liquidity is not an issue. Liquidity is surplus. Clearly on the equity side, a lot of liquidity is there, which is driving the markets. Uh, However, I think we have also seen uncertainty going into the elections in the past. So while there are central elections in May, June of coming year, but before that, there will be a few state elections as well. 3 to 4 big state elections are also scheduled over the next few months. So going into these elections, the one would get early signals in terms of what is the sentiment on the ground. And also, and in the past, we have seen going into the elections, there will be some jitteriness, and that's where one cannot rule out volatility going into the elections. That is one. And second is uh, we have seen spending by the government is also happening, which happens over in the last 1 year of prior to elections. So government spending, as we see, has gone up, is on an uprise, which is a positive for the market. On the macro side, I think one negative that one should be watchful of is crude price, which has gone up from almost $70 all the way to $92. So that's a macro worry that one should be aware of. Uh, so that's something that one has to balance out. Otherwise, things are looking okay.
So no doubt we are seeing most of the questions in the Q&A section on the small cap as a category. There are a couple of questions in terms of balance advantage. So we are underweight in IT as a sector in balance advantage, and we are a bit overweight in our small cap fund. So any strategic call you have in both these sides of the fund?
Right. Yeah. So that's a good question. So basically, on the balance advantage side, the over underweight in IT was a tactical call in terms of because the IT services stocks, we were seeing growth deceleration, and which is what has played out. And that's where that has helped us to be underweight on IT services. But incrementally, we believe that one should turn neutral at least on the IT services space. So that's on the large cap side. We have, by the way, there's also a divergence within IT services where small and mid caps are doing much better than large caps. So that's where we are underweight, and Balanced Advantage is predominantly large cap oriented fund. So we have been underweight on large cap IT services companies, while on the small cap fund, we could see growth rates being higher and valuations being reasonable on the IT services side, which is where we are slightly more constructive on small and mid cap IT services companies. Second is there are other companies like some of the other tech companies within the small cap space which are not uh, traditional IT companies. For example, a company like CE Infosystem, which is a map based company, employs map services to companies like Zomato and Swiggy. So this is considered to be a technology company, but it's classified as an IT services company. So if we remove the technology companies, then IT services would be underweight even in small caps.
So thanks, Vishal, for that. How we see manufacturing as a sector, because the current government in their first tenure started the Make in India story, and actually it picked up the entire space, picked up genuinely post 2019 September, where they had given that impetus in terms of corporate tax. Then COVID happened. Then the entire world shifted to China plus one theory. Our population is also in terms of demographic favorable, where consumption is picking up, the demand for local products is picking up. So how you see manufacturing as a sector, because we are bullish in terms of the allocation as per the portfolio you have shown.
Right. Yeah. Yeah, you are right. I think we are very positive on the Make in India theme. And that's where, if you look at the portfolio composition for the small cap fund and even for the Balanced Advantage fund, we have a lot of stocks which are part of the Make in India theme. For example, sectors like industrial manufacturing uh, uh, plays into that theme of Make in India, construction in the industrial manufacturing. So these are the themes that we are positive on, and we are overweight from a sector allocation perspective. So apart from the government schemes like PLI, etc., because of China plus one strategy, we are seeing a lot of interest in this theme, a lot of investments which are happening in this sector. Firstly, because it is advantageous for corporates because of the production linked incentives. Second, there are import duties which have been imposed. Therefore, government clearly wants domestic manufacturing. Apart from that, there are export incentives, uh, and even companies, let's say countries like Europe and US, want to increase their outsourcing from India rather than China. Even today's Economic Times headlines, you would see similar rhetoric on Europe, including France, wanting to uh, de-risk themselves from excessive dependence on China. So the developed nations want to de-risk their supply chain, and that is why countries like India are at the forefront of benefiting from this trend.
So the consumption side, or the capex side, rather not consumption, the capex side was more initially from the government side, and which currently still is. But in today's Economic Times article, when we look, a similar article is there where the IPOs which are coming, we are seeing more of the capex coming from there as well, looking at how they are going to utilize the funds which they are going to collect through IPOs. So are you seeing the actual private capex moving up?
Right. So, yeah, you are right. Government capex has been strong, but we all have been waiting for the private sector capex to kick in. So right now, if I look at the capacity utilization levels in the industry, which is being published by Reserve Bank of India, we are at around 70% levels of capacity utilization levels. But we are seeing stress in certain areas. For example, in case of energy consumption, electricity generation, we are already seeing signs of stress, where our demand is starting to exceed the supply, and the supply pipeline is also looking weak for now. Supply pipeline is there in terms of renewable energy, etc., but that is not good enough to meet our peak demand requirements as we progress as a country. And that's where there is urgency to put capacity in these areas, be it electricity, infrastructure, and other areas. So that is one. So even private sector capex, for that matter, railways, electricity, we are seeing private sector also participating and benefit from these trends. Apart from that, if I look at cement, for that matter, over there also we are seeing increased capex happening because of the huge runway for uh, demand growth. Demand growth is around 7-8% annualized, which is pretty good for the cement sector, and which is what is leading to capex happening in these industries.
So Vishal, coming to the funds, at current juncture of markets, how much investor should pump in terms of his allocation if he has a lump sum, and to what extent or to what time frame he should do the STP? So is it as advisable to have a 6 months, 9 months STP, or how it is?
Yeah. So what we are advising to our investors is that if one is looking at lump sum investment, one should come in hybrid category funds, be it balanced advantage or multi-asset allocation fund. These are good funds to park your lump sum money, because one is getting diversification into different asset classes, and one gets a balanced experience in terms of ups and downs of the markets. One would get a good average. So lump sum is good for a hybrid category. Um, and if one is, and for pure equity funds, including small cap fund, one can look at SIP and STP routes. And we are advising investors to come in with a slightly longer time frame of SIP, STP. SIP can be ongoing. For STPs, we are actually advising 1 year kind of a time frame, because the markets have run up. So if the markets were to correct, one should get a good average. So from that perspective, a 1 year kind of STP will actually make sense at these levels.
So that's thanks on that side. In terms of small cap and balance advantage, when I look at performance, both the funds are top quartile on 6 months basis, 1 year basis, and 18 months basis. So that gives a reflection post you taking over both the funds. The funds are doing well. So what you feel from here will make this performance a consistent one, because that is where people look at how consistent the fund is. So one line of confidence will help the entire audience.
Yeah, so as you rightly mentioned, both these funds have seen improvement in performance over the last 1 year, 1.5 years. There is appreciable improvement in performance. Our endeavor here is to not be contented and happy here, but to strive for better performance going forward. So idea is to make sure that not only do we maintain this performance, but we need to show better performance going forward. In case of small cap, for that matter, if I look at slightly larger time frame, 5 years plus, performance hasn't been great. So our internal target is that we need to start looking at improving long-term performance. And that's what our target is. And for that, what we are doing is that there's massive focus on processes. And for example, we took you through what changes we have done in the investment process side, both on small cap and balance advantage side. So in our presentation also, 70-80% of focus is on processes. While we are working in our office, the focus is on getting the process right, uh, to make sure that the performance is replicable and sustainable as we go along.
So thanks, Vishal. I think you covered the markets, you covered small cap as an index, you took us through the processes and where we have put the uh, ROC model for small cap, how we have defined in small cap. So that gives a confidence when you look at a investment journey, you will have a smooth ride rather than a bumpy ride. So thank you so much for that. And with this, we come to the last question, which is one sunrise sector you feel will or you bet on.
Right. So I think right now we talked about Make in India. So that's something that as a theme looks really strong. Within that, electronic manufacturing services is something that is a sunrise sector and there's immense scope. Having said that, I think valuations have gone up quite a bit in this space, and therefore I think one needs to be very discerning here with stocks to pick, but the sector or the theme per se looks very strong. And within that, one has to pick and choose the right stocks for the portfolio. And we believe that this sector can actually provide 20-25% annualized kind of growth rates for the next 3 to 5 years. So that will be my pick. But within that, which stock to pick is something that one has to be very discerning about to pick the right ones where the valuations are reasonable.
So there's one question which I will take. What's the net equity exposure of BAF? So as of 8th September, the tentative net equity exposure for BAF stands at 52.02%. So that's there what Rahul was asking. So with this, thank you so much, Vishal, for your time taking us through both the funds, make us understand the process in depth, what all changes you have done, and what's the road ahead for both of the funds. So with this, we look forward for your participation. So audience, next Thursday, we have lined up a call with Kaustubh. Invitation will come. So the call with Kaustubh would be on the bond inclusion in JP Morgan index. So how it is going to impact. Though Vishal has briefly touched what is the impact going to be larger on debt and how we look at equity as a thing. But for a better understanding, we have arranged a call next Thursday. So do look forward for your participation. With this, thank you so much, guys. Have a wonderful evening. Thanks, Vishal, once again.
Yeah, my pleasure. Thanks a lot. Have a wonderful evening, everyone. Take care. See you.